So picture two investors. They both start with the exact same $50,000 investment. And, they both hold it over the exact same 12-month period.
Okay, pretty standard scenario.
Right. So investor A puts their $50,000 to a massively popular brand name athleisure company. Fast forward 12 months, and they are left with $24,000.
Oh, wow. So they took a total bath.
Yeah. Their portfolio has essentially been cut in half. But then investor B takes their $50,000 and puts it into a dusty, boring old computer maker that honestly, most of the financial media had completely written off.
I think I know where this is going.
12 months later, investor B walks away with nearly $160,000.
It's just a stunning divergence. I mean, both of these investors made what conventional financial wisdom would call a reasonable choice.
Right. They weren't gambling.
Exactly. They bought established multi-billion-dollar companies. They weren't rolling the dice on, volatile penny stocks or some crazy speculative derivatives.
But that is a $136,000 gap between two supposedly safe choices. And here is the really shocking reality of that gap. Neither of those investors picked a fundamentally broken company.
No, not at all.
I mean, the athleisure brand still sells millions of units worldwide. The old computer maker still builds and sells computers. This is our daily trading desk brief. We are taking notes straight from the trading desk to explore the mechanics of sector rotation. And we are going to use that exact $136,000 gap to stress test your portfolio against a looming late July catalyst.
And, the crucial takeaway from that opening scenario is that the gap had absolutely nothing to do with the individual stocks themselves.
Right.
It was entirely driven by the broader sectors those companies belong to.
Yeah.
And the exact same invisible macroeconomic force that created that massive gap is about to test your own portfolio, specifically in the last week of July.
And I bet most people won't even realize they're heavily exposed to this test until the damage is already, recorded on their monthly statements.
Exactly. It's going to get a lot of people off guard.
Well, let's dissect this late July catalyst.
Yeah.
We are moving from the historical reality of that massive financial gap straight into an immediate calendar event.
A very crowded calendar event.
Yeah, this 48-hour window is going to expose whether you are swimming with the market's current flow or, honestly, getting dragged under by it.
When we look at the actual calendar, the last week of July is shaping up to be the ultimate stress test. Everything converges at once.
Give us the exact dates.
So on July 29th, the Federal Reserve sets interest rates. That decision acts as gravity for the entire market because it dictates the cost of capital.
Meaning how expensive it is to borrow money.
Right. In simple terms, it determines how expensive it is for companies to fund their operations and their growth. When borrowing gets expensive, high-growth companies are usually the first to feel the squeeze. And on that exact same day, Microsoft and Meta report their earnings.
Microsoft and Meta,
Yeah.
two of the largest technology companies on the planet, reporting literally hours after the organization that controls global borrowing costs.
And it doesn't stop there. They are followed the very next day, July 30th, by Apple and Amazon reporting their earnings.
Wow. Okay, so you hear those four names: Microsoft, Meta, Apple, Amazon. And I think a lot of people think, sure, those are massive tech companies, but I own a broad, diversified index fund.
Right, the classic retail investor mindset.
Yeah, they think I track the S&P 500, I am insulated from single company risk, but we really have to look at the underlying math of how those funds are constructed.
Yes, the weighting.
Exactly, because those index funds are market cap weighted, meaning the bigger a company gets, the more of your money the fund automatically funnels into it. Right now, those four companies alone quietly make up roughly 32% of the S&P 500.
It's staggering. Nearly a third of your entire diversified portfolio is resting on the shoulders of just four companies.
Just four.
And all four are reporting within 24 hours of a massive Federal Reserve rate decision.
I mean, I look at a standard index fund right now as a Trojan horse. You buy it thinking you are bringing this beautiful, broad, safe diversification into your portfolio's defensive walls.
That's a great way to put it.
But hidden inside its belly is a highly concentrated bet on artificial intelligence and big tech. Because of the mechanics of market cap weighting, you're inadvertently sneaking a massive risk right past your own defenses.
The Trojan horse analogy is perfectly accurate. If you own a plain standard index fund right now, You are long the AI trade, period.
Yeah.
It doesn't matter if you meant to be or if you even follow the artificial intelligence industry. Your capital is making a huge concentrated bet on it.
And this specific late July window is the moment that specific bet will either justify its massive valuation or crack under the pressure.
Exactly.
Which brings us back to our underlying mission. We've established what is at risk, this massive hidden overconcentration in big tech. To protect ourselves, we have to understand how the market actually operates under the surface.
Right, because it's rarely about the daily news cycle.
No, it's about the mechanical flow of money moving from one industry to another. So let's run through the actual scoreboard of this year's losers and winners.
And the contrast in these numbers is striking when you look at where the capital is clinging versus where it is accumulating.
Let's start with the losing side. These are crowded, beloved story stocks that just completely dominate financial media. We have an electric car darling down 45%.
Ouch.
That athleisure brand from our intro is down 43%. A massive social app is down 40%.
It's this massive drawdown.
A giant Chinese conglomerate down 38%. A crypto treasury proxy down 35%. And it is not just individual names either.
No, broader sectors are bleeding.
Yeah, software is down nearly 9% this year and down 13% over the last 12 months. Medical devices are down 16%. These are mostly profitable companies taking massive hits to their valuations.
And then, we have to look at the other side of the ledger. Where did all that money go?
Right. The winners are almost uniformly boring physical hardware companies.
The dusty stuff.
Exactly. A memory chip maker has tripled, up over 200%. Two old legacy hardware names have also tripled.
Wow.
A chip design company is up 175%. Even a beaten-down, totally ignored vaccine maker is up nearly 160%. Looking broadly, the entire chip basket is up nearly 60% this year alone.
The crucial mechanism to understand here is causality. The losing companies didn't see their valuations cut in half because their management teams suddenly forgot how to run a business.
Right, they didn't just break overnight.
And the hardware companies didn't triple because their executives became overnight geniuses. This divergence happened because institutional money systematically locked in their profits from crowded software sectors and rotated billions of dollars into the physical hardware that actually powers the new technology infrastructure.
Okay, but I want to push back on the timing of this, though. If our entire approach is just following the money after it has already moved into these boring hardware names, aren't we guaranteeing that we are late to the party?
That's a fair question.
I mean, aren't we just buying at the top after the institutions have already made their triple-digit gains?
That is a very common psychological hurdle, but it fundamentally misunderstands how institutional capital works. Trying to predict the absolute bottom of a market is like trying to jump onto a speeding freight train.
You are going to get crushed.
Exactly. Being one step behind the institutional money is actually the safest strategy. You don't need to be early. Institutions are moving billions of dollars. They can't just click buy on a retail brokerage app, or they'd instantly spike the price and ruin their own trade.
Right, they'd move the market too much.
So they have to accumulate shares slowly, quietly buying a little bit every day over weeks or months.
So they're essentially hiding their massive orders by breaking them into thousands of smaller transactions.
Exactly.
And we can see the evidence of that accumulation if we know what to look for. Our notes from the desk point to two specific mechanical conditions that reveal this footprint. The first one is called the coil. Explain the mechanics of a coil.
So that invisible, suppressed buying by institutions creates a very specific pattern on a chart. Imagine a sector trading completely sideways in a very tight, boring range for weeks or even months.
Just flatlining.
Right. The price isn't going up,
Yeah.
and it isn't going down. It is just flat. It builds up pressure. The retail investors get bored and sell their shares because the stock isn't doing anything exciting.
And who is quietly buying those shares?
The institutions. Eventually, the institutional order is filled, the pressure becomes too much, and the stock breaks out of that tight range with conviction. That breakout is the definitive footprint of institutional money.
We have a perfect real-time example of this mechanism with the biotech sector.
Yeah, absolutely.
For 2 full years, biotech was basically dead money. It just coiled sideways, building pressure, while everyone else in the market was obsessing over artificial intelligence.
Right, totally ignored.
Retail investors completely gave up on it. Then, last month, it finally broke out. And because of that massive 2-year buildup of pressure, it ran 25% in just a matter of weeks. As of today, it is up 32% on the year.
And see, you didn't have to predict the bottom 2 years ago. Waiting for the trend to reverse and the footprint to appear is like waiting for the train to actually pull into the station.
You just watched for the coil to break and you stepped in.
Exactly. You weren't early, but you safely captured a 32% gain.
Which brings us to the second mechanical condition to watch for, the 50-day moving average. And just so we're all on the same page, a 50-day moving average is simply the asset's average closing price over the last 10 weeks, plotted as a continuous line on a chart.
Right, it smooths out all the daily noise and volatility.
Yeah, and it shows you the actual direction the river is flowing.
Exactly. We look for the price of the asset to be trading above its 50-day moving average line. But crucially, that line itself must be sloping upward.
That's the key.
Yes. If the price is above an upward sloping 50-day line, you are swimming with the institutional current. The momentum is at your back.
So we know how to identify where the money is flowing. We look for the coil, and we verify the momentum with an upward sloping 50-day line. But knowing when to enter a position is really only half the battle.
Often the easier half.
Yeah. We need to explore the exact rule that separates the $24,000 portfolio from the $160,000 portfolio.
Which is knowing when to leave.
Yes, the exit strategy. The desk uses a very specific indicator for this, which they refer to as the 150-day kill switch.
The 150-day moving average, which represents roughly 30 weeks of trading data, is a long-term trend indicator. It is the definitive signal that the institutional money has left the building.
The party is over.
Exactly. If the price of your asset closes below that 150-day line, the long-term trend is broken. That is the kill switch. There is no debate. There is no hoping it bounces back. You simply exit the position.
Okay, but I have to challenge the rigidity of this.
Go for it.
Can a single mathematical line on a chart really dictate a strategy? I mean, doesn't relying on a strict 150-day kill switch completely ignore the fundamental underlying value of a great company? What if their balance sheet is incredible and their earnings are strong?
Well, fundamentals absolutely matter over a 5 or 10-year horizon. But fundamental value will not protect your capital from a vicious, near-term sector rotation. When institutions decide to reduce their exposure to a sector, they sell everything, regardless of how good a specific company's balance sheet is. Let's look at the 2022 big tech basket as the perfect counter-argument to holding for fundamentals.
Okay, let's hear it.
In 2022, the tech sector rolled over. Investors who followed the mechanical rule and stepped aside the very moment the price lost that 150-day line took a single-digit loss. It was a paper cut.
They preserved their capital.
But the investors who ignored the line, who argued that the fundamentals of these massive tech monopolies were too good to sell, they rode that basket down 35%.
Brutal.
And then they had to sit there with their capital trapped in a drawdown, waiting 2 full years just to break back to even.
Well, let's walk through the devastating math of break even, because this is where wealth is truly destroyed. If you take a 50% loss on a position, you don't just need a 50% gain to recover. You need a 100% gain just to get back to zero.
It's a massive hole to dig out of.
Let's look at the opportunity cost. Say investor A steps out when the 150-day line breaks. They take a small 5% scratch, preserve their capital, and move that money to a new sector where the institutions are actively buying.
They catch a new rotation.
Right. They make 10%, turning their preserved capital into meaningful profit.
Their money is working for them elsewhere.
Meanwhile, investor B ignored the line. They rode the crash down, and now they are agonizing, waiting months or years just to claw back to their original starting balance. They haven't made a dime.
Just dead money.
Yeah, and that head start that investor A generated by avoiding the crash. If we compound that head start over 10 years at a standard 10% return, it becomes a staggering $64,000 gap between the two investors.
Wow. See, you aren't just losing money on the way down. You are suffering the massive opportunity cost of what that capital could be compounding in a sector that is actually moving up.
Let me ask you about the gray area between these indicators, though. If I run my portfolio scan and I find a position that has fallen below its 50-day moving average, but it is still trading comfortably above its 150-day moving average, what is the read there? Is that a hold or a sell?
That is essentially a yellow traffic light.
Okay.
Remember, the 50-day line tracks short-term momentum, while the 150-day line tracks the long-term trend.
Okay.
So if it loses the 50-day but holds the 150-day, it means the short-term momentum is waning, perhaps due to a broader market pullback, but the overarching structural trend is still intact.
So no need to panic yet.
Right, you don't necessarily panic sell, but you stop adding new capital to that position, and you watch that 150-day line like a hawk.
And we are seeing the reality of these levels play out in real time right now with Bitcoin.
Oh, a perfect example.
Currently, Bitcoin is trading around $63,000, but its 150-day line sits all the way up near $70,000.
Right, so it's below the line.
Yeah, it is trading roughly 10% below its own kill switch. The math has given its answer. The long-term trend line is flashing red. The only question is if the holders are looking at the mechanics or if they are blinded by the narrative and willing to ride it down into that devastating break-even math.
Which naturally leads us into the broader mechanics of managing risk. Knowing the 150-day exit protects you from catastrophic trends, but you also have to manage the size of your initial positions.
Because losses are inevitable.
Exactly. Even with the best mechanical rules, you are going to take losses. The market guarantees it. The goal is to ensure those inevitable losses are just scratches, not severed arteries.
Well, let's talk about the math of position sizing, which is really your ultimate defense mechanism against volatility. Let's say you get overly confident about a specific narrative and you allocate a full 25% of your entire account into one single stock.
That's a huge bet.
If that stock suffers a 20% drop, you just killed 5% of your total overall portfolio. That is a heavy structural hit that triggers emotional panic.
And emotional panic leads to abandoning your rules entirely. You make bad decisions.
Exactly. But let's look at the alternative. If you apply strict sizing mechanics and you only allocate 3% of your total portfolio into that exact same stock.
A much smaller bet.
Right. If you have a $100,000 portfolio, that is a $3,000 position. If that stock drops the same 20%, you lose $600.
Which is nothing in the grand scheme.
It is 0.6% of your total portfolio. It's barely a rounding error. You don't panic sell at the bottom over 0.6%. You sleep soundly, you stay rational, and you execute your exit strategy unemotionally.
Sizing keeps you rational on the downside, but we also have to manage the upside. How do you protect profits when you catch a massive rotation? Let's say you bought that vaccine maker we discussed earlier, the one that ran up 160%.
Oh, a massive winner.
How do you avoid watching that life-changing gain evaporate when the institutions inevitably rotate out?
You use a trailing exit, nobody consistently catches the exact top of a market. And trying to predict it usually means selling way too early.
Which is frustrating.
Yeah. So instead, you establish a mechanical rule to give back a small set percentage from the absolute peak, say 6%. As the stock climbs, your exit point climbs with it, always staying 6% below the highest high.
I love that. When the trend finally breaks and the stock drops 6% from its peak, you are automatically out.
You lock it in.
You leave a few crumbs on the table at the very top, sure, but you mathematically lock in the overwhelming bulk of that massive winner instead of round-tripping the entire gain back to zero.
Okay, so we have established the mechanics of entry, exit, and risk management. Now we really need to apply these rules to the current market environment. What is the real-time read from the desk as we approach this late July catalyst?
Well, before we get into that, we should be absolutely clear to everyone listening.
Good point.
We are discussing the analysis of institutional money flow and exact mathematical levels. This is absolutely not financial advice, and we never tell listeners to buy or sell any security.
Perfect disclaimer. Okay, so what's the read?
The current analysis is very clear. Money is aggressively rotating out of the highly crowded, index-heavy AI trade.
It's shifting.
The institutional capital is locking in those historic tech profits and quietly moving into uncorrelated traditional sectors.
Uncorrelated being the key mechanism there. They are seeking out sectors that operate independently from technology so they won't get dragged down if those big tech earnings disappoint.
Precisely. The flow is moving into the boring fundamentals. We are seeing major banking institutions hitting new highs, actively breaking out of long sideways coils.
Right.
Consumer staples, the remarkably dull companies that manufacture household goods and groceries, they are basing out and turning upward. And freight rail, a vital economic indicator, is currently coiling right at the edge of a major breakout.
I mean, it's the ultimate dusty old computer maker setup all over again. While retail investors are fighting over the last scraps of the artificial intelligence narrative, the institutional billions are quietly flowing into freight trains and checking accounts.
Exactly.
So to make this data actionable, the desk outlines 3 specific mechanical exercises. We'll call them the 3 Sunday steps to prepare your portfolio for this exact rotation.
Step 1 is the pair. This is a strategy for rebalancing your exposure without panic selling.
How does it work?
You begin leaning into the new momentum allocating toward those banks, staples, and rail sectors. At the same time, you systematically trim your big tech exposure if those specific tech names start falling below their individual 150-day moving averages.
So you are pairing the rising institutional strength with the falling weakness.
Exactly.
Step 2 is the Sunday scan. And I honestly appreciate the ruthlessness of this exercise. Every single Sunday, you sit down and look at the 150-day moving average across every single position you own.
It's a non-negotiable habit.
Right. If you find an asset sitting below a falling 150-day line, it comes off the books. There are no sentimental exceptions. You don't hold it because you love their consumer products, and you definitely don't hold it because a talking head on television said the fundamentals were strong.
The math doesn't care about the TV talking heads.
Exactly. If the math says the long-term trend is broken, the position is gone.
So step 2 is purely defensive. It preserves your capital. But step 3 is where you identify the next massive structural opportunity. Step 3 is called worst to first.
And step 3 sounds completely counterintuitive. Why are we scanning the absolute bottom of the barrel if the entire point of this strategy is to follow positive momentum?
Because today's momentum was born from yesterday's despair.
Oh, that makes sense.
Instead of chasing the heavily publicized stocks that have already surged 50% and are plastered across the financial news networks, you look at the absolute bottom. You scan the 5 most hated, aggressively sold-off sectors in the entire market.
But you aren't just buying them blindly.
Oh, definitely not. You are simply watching them, waiting for the mechanics to shift. You wait for their downward trends to finally flatten out, for the selling pressure to exhaust itself, and for the invisible institutional accumulation to begin forming a coil.
You are hunting for the footprint of the next biotech run.
Exactly.
You're using the mechanics of accumulation to catch that 40% move before it becomes obvious to the rest of the market. Well, we have covered a massive amount of ground today, exploring the underlying machinery of how capital actually flows.
We covered a lot of math.
We did. We started with the looming late July catalyst, the Federal Reserve rate decision colliding with earnings from Microsoft, Meta, Apple, and Amazon. This is the ultimate stress test for an index fund system that has become dangerously top-heavy.
And, the essential takeaway here is that you do not have to rely on passive hope, brand loyalty, or expert predictions to navigate that stress test.
You just use the mechanics?
Yes. You have the 150-day line to dictate exactly when the institutional money is leaving. You have the coil and the 50-day line to illuminate where that money is quietly flowing next. You manage your position sizes to protect your psychology, and you use trailing exits to capture the bulk of the move.
Before we wrap up, we want to reiterate our strict disclaimer. This is absolutely not financial advice, and it is not an instruction to buy or sell any asset.
Do your own rigorous homework.
Always. The market is unforgiving, and it does not owe anyone a soft landing. Always protect the capital first. Think back to our 2 investors from the beginning.
The athleisure versus the dusty computer maker.
Exactly. Both started with $50,000. One walked away with $24,000, the other with $160,000.
A massive difference.
If a simple, unemotional, strictly mechanical rule, like a 150-day moving average, can so vastly outperform complex emotional decision-making, brand loyalty, and the loudest analyst voices in the room, what does that actually say about the true value of the daily financial narratives, the screaming TV pundits, and the nonstop news cycle we consume every single day?
It is a profound question to consider. Perhaps the truth of the market isn't found in the story, it's found in the line.
Let the math tell the story.